Yeah, so let's kick it off. I did invite the essentially the head honcho of the team that most of you give your money to. That's Michaeli Beach, and later on in this presentation, I'm going to have her go over her operations, how they go about finding deals, scouting for opportunities, executing as flawlessly as they do. So this idea, by the way, I forget who was asking for this, but basically in a survey that I did a few weeks ago, it was requested that, you all don't know how well the team's performing, if there are mistakes happening, and everything else in between, which I think is a fair request. And so every quarter now, I'm going to do this. I'll give you the updates, kind of where I see the market going, what the team's up to, and just the overall performance of our portfolio. Okay. So, but today, I think it's really important that we do touch briefly on the real estate market. There's been a lot of changes as of late, so we should talk about that. We're going to talk about what and why Kansas City, what's happening there, why it's even an attractive market in the first place. We'll go over the performance of the portfolio across all of our loans. And then I'll hand it over to McKinley to really focus on what I think is the epitome of operational excellence when it comes to a team that flips. And I've worked with a lot of teams, and I'm telling you, this team really has it dialed in. And so we'll go through that in detail and let her talk quite a bit. And then we'll open it up for Q&A and go from there. So a few things, just some rules of the game. Please do stay on mute until we have Q&A. In the meantime, use the chat function for any questions, and I'll be sure to answer them as I see them pop up. And let's do our best to sort of stay on this topic. Real estate can go in a million directions, so we'll try to focus on this one topic, okay? All right, so before we get started, I think it's really important to think about passive investing and sort of investing as a concept, right? And I just did an interview yesterday with Ali Boone, who's kind of a big name right now in the investing world with turnkey rentals and everything else. And she showed me this image. It's two, I guess, cartoons, and there's two ladders, right? On the one side, it's a ladder with small little rungs up to the very top. And the other side, it's a ladder that has a big gap in the middle. And it's the idea that with the big gap in the middle on the ladder, there's a lot of investors that I see chasing Bitcoin, chasing the GameStop trades, chasing Tesla, that want to get ahead with 30-40% returns, right? And keep in mind that higher returns comes higher risk, higher volatility, and often a lot more effort. And so I think you'll see, our average return in this portfolio is 17%. And to be honest, it's a pretty passive investment. So this statement, I think, rings home to a lot of us. Those big swings, those grand slams are great when they come to fruition. They rarely do, but if they do, fantastic. What you should really be focused on is thinking about how to create consistent income and rather safe investments. Okay. All right, cool. So let's talk about the real estate market, what I think is happening. There's so many headlines out there. There's a lot of people on YouTube with the clickbait talking about housing crashes. And I've had my fair share of debates with a number of people. Okay. But there's a few things that I think are really keeping this market as crazy as it is. Now, when you think about real estate and really any asset, there's still the supply and demand equation, okay? And we have inventory levels today that are the lowest they have been since 1982, all right? And there's a lot of reasons as to why that is. One big reason, back in the '08 crash, a lot of developers went belly up, leaving only the ones that had good cash flows and good cash cushions to stay in the business. We also had a massive reduction in subcontractors. Back in 2008, we had 13 million people in the business doing subcontracting, drywall, painting, and all that. Today, it's around 10.8 million, right? With an increase in need. So we have a major gap in skilled workers. And the stories I'm hearing in the field about bids are just, it's asinine, the amount of gouging that's happening. I'm sure Michaela can relate when plumbers are making more than lawyers today, okay? And so there's a massive shortage with inventory, and that's driven by the fact that developers have a hard time managing subcontractors, and commodities are booming right now, right? Look at copper and PVC piping, plastic materials, lumber at all times high. There's a lot of pressure on the material side. So developers cannot find a way to produce affordable housing, especially in this turnkey market. There's just no way they can compete on these new builds. So that's really great news for people like McKaylee who are producing these turnkeys for investors that do cash flow. Okay. A few more key pieces. I think there's a big push right now towards digital property management. So the idea of owning properties out of state is becoming a reality. Back in 2016, I had to sell the idea of owning a turnkey out of state. People just didn't want to touch anything outside of California. Today, I mean, I'm sure McKaylee can attest to this. She's selling properties before they're even done doing rehab, right? There's such a big demand from new investors wanting to own turnkey properties that it's hard to keep the inventory on the shelves. Okay. All really good things ahead, I think, for real estate in general. And we'll go into some more stats here right now. Okay. Any questions before I jump into that? Cool. All right. So what lies ahead? If you haven't been living under a rock, then you've probably seen the 10-year treasury note just skyrocketing as of late, right? This matters because this is one of the benchmarks that banks use to gauge where they place their mortgage rates. Now, typically what happens with 30-year fixed mortgages is it's pegged to the 10-year treasury, and you'll see around a 200 basis point spread between the 10-year note and a 30-year fixed. What that means is if the 10-year is at 1.75%, you could expect the 30-year fixed to be around a 3.75%, okay, on a primary home. Add another 0.5% for investment properties, okay? Now, I think where we get into trouble is when this 10-year goes to 3.5%. I think that is when the real risk to a flattening appreciation or even potentially a correction in the real estate market exists. For now, I think we have a lot of room to go. And I think a lot of economists expect the 10-year to hit around 2% by the end of this year. Okay, so that would mean about a 4% 30-year fixed rate for primary homeowners. Okay, so still very attractive cost of debt. I don't foresee this being a massive headwind right now, but I think it's good for us to think about this long-term as well. Again, obviously higher interest rates do translate into a reduction in affordability. So that's kind of how this is all going to work. But we're seeing appreciation rates of 8 to 12%. So, I think what's going to happen is that as this goes up to 4.5, even 5%, you'll see the appreciation rates come back down to the mean of around 3 to 5% annually. I still don't see a crash. There is 2.5 million foreclosures looming, but even with that supply, we're still at a 1.1 month supply, which is just bananas. You need about a 6 to 8 month supply of housing units to begin to see that buyer's market, and we're a long way away from that. And then lastly, Biden's team has been pushing this idea of a first-time home buyer credit. I think it's the wrong credit. I think we actually need one for developers, not for home buyers. So this will put more demand on homes, and again, probably more appreciation. Okay. So net, pretty big upside, I think, for real estate. I don't see it cooling too quickly, but we could see some risk to the appreciation going back to the mean of 3 to 5%. Cool. All right. So I want to talk about Kansas City. And what I'm going to do here is when I go about looking at metros, I have a rather involved model that I use, 27 variables, and I have all these weights and everything else. But I'm going to hit on some key metrics that I think shows that Kansas City is a viable market for investing. And I think this is why McKaylee's team has had such success in selling these turnkeys. Okay. So quite simply, inventory. Where is Kansas City in terms of inventory, days on market, and year-over-year price growth? Well, today, you can see that over the course of history, you're probably around 60 to 80 days on market on average for Kansas City. Today, we're at 22 days on market, which is right around the national average when you look at the housing market. So, and we'll get her take later on as to what she's seeing in terms of demand and days on market. I'm pretty sure it's even lower than that for the turnkey business. Okay. Supply, again, right around the national average, and basically no supply is what this means. That 6-month supply is kind of the balancing of buyer and seller, and they're at a 1.1 month supply. So that's indicative of putting up a property, getting an offer within 1 to 2 weeks. Yep. Okay. And then lastly, this is a big thing too. I think, and I have some other metrics for you all just to compare what this means in terms of your market. Most of you are West Coast, but when I look at appreciation, I don't just look at overall price. I look at specifically single family homes, and I look at within the metro, and then I want to understand on a per square foot basis, right? Not so much just any home at all. I want to understand what are people willing to pay per square foot over time. And I think a good barometer here is that you want to see an appreciation rate of 3 to 5% on that willingness to pay for per square foot. There's something called a CAGR, cumulative annual growth rate. Basically, it's the average of growth over time. You can see that Kansas City has had a 7.6% growth rate annually on the willingness to pay per square foot. So very attractive growth rate. And to put it in perspective, when you look at something like San Francisco that went through a boom in the last 10 years, including those 10 years, they had a 10.9% CAGR. So you're pretty close in growth rates for a market that really hasn't had that huge tech boom like San Francisco has. And to put it in comparison to Austin, which is now arguably the next San Francisco in terms of appreciation, you're right around that same CAGR, okay? Make sense? I'm getting all math nerdy on you guys. Cool. All right, so two really important variables that I look at on every metro. The first one is population growth. And the way to think about this is you need to compare the population growth of a metro versus the baseline average of the nation, right? So the nation's averaging around 0.8 to 1.2% in population growth rates. Kansas City, even when you factor in this little dip here, which I don't know what happened here, but I guess the recession and I assume job migration out was kind of the result of that, but that's all back now. The CAGR is right in line with the national average. So they're seeing around a 1% year-over-year population growth rate. That matters because you want to have consistent demand on housing, and that's driven by the population of the city, okay? So that's a good sign off the bat here. Income growth, this is the other one. Naturally, the faster the income growth, the more affordability they can experience, and therefore more appreciation on your assets, which is probably why we're seeing a 7.6% annual appreciation rate on per square foot, because you're seeing a 5.4% appreciation rate annually on income growth, which, by the way, is around a 2x average of the national average. So this, coupled with low interest rates, should result in a CAGR on a price appreciation of around 6 to 8%. So that makes sense. You're seeing very healthy income growth in the market. And again, that results in this very strong and stable real estate market. Okay. All right. Let's talk about the portfolio. This is really exciting. I don't know what to say. It's overall just a success. So first things first, out of all of our contracts that we've done, I think we've had either one or two that we've had to extend beyond 6 months, right? And that it wasn't like it was a problem with the deal. It was just an anomaly here and there, but we've had no mistakes, no defaults, and no errors in any deals so far. Okay, so hats off to McKaylee and team. It's a hell of an accomplishment for doing essentially 60 deals in 2 quarters. So what you see here in the left in the green box, this is deals in process, not quite into rehab, either that have been funded or are about to be funded. And then in the right, those are deals that have been funded, either are in contract for close or are currently in rehab, okay? So it's a pretty even split across the capital. The total portfolio is around $3.6 million of capital given, and about 30 deals are in process of being funded or already funded. And then about 30 deals, I guess 28 deals, are in the process of rehabs and in the process of selling, okay? So some really interesting facts here I want to talk about is a per deal metric basis, right? So on average, you all are lending to these deals in the size of around $63,000. I'm sure most of you would agree that's about where what your amount is, okay? One thing I have seen go up in price is the rehab amount, which makes sense. It's costing more to do rehabs. So the average rehab cost is around $24,000, which is still very much in line. They're turning these deals in 4 months. And now, while McKaylee would love to not pay points, I think that's all to your benefit. you want these things to turn as fast as possible, right? More points equals more ROI. And that's kind of why this turnkey model is so attractive versus a flip or like a syndication that never really turns, right? The beauty of this, though, are in these last two numbers. Okay, I would wager a fair amount of money that you would be hard pressed to find a leverage of 60% LTV that still yields a 17% ROI in the market. Okay, now again, this ROI is driven by the fact that they're turning these deals so quickly. Okay, now if they weren't turning these but once per year, this would be closer to 13%, which is more in line with the industry standard. But because they're turnkey deals, they're turning so quickly, you're getting a rather low leverage deal for a rather very high return of 17%. Okay, and that's why this is such a good model for everyone. Low risk, fast turns, and ultimately the ability to recycle your capital faster and faster. Okay, I said a lot. Are there any questions? Everyone's just so happy and in awe. Okay, cool. All right, last piece here, and then I'll kick it over to McKaylee to do her bit. I think when, well, I know I send you all this analysis and there's all these numbers, and one that I look very closely at is this risk score. And I'm sure you've seen it and you're probably like, Tom, what the hell is this? Great, it's 0.6. What does that mean? Well, I wanted a quick way to gauge the risk of a score, which would help me then talk to McKaylee and say, hey, this has too much capital given. We have to dial back on the rehab amount, or maybe do a draw schedule or whatever it is, right? And there's four main components of the risk score. And within these components, there's multiple variables that make up each one of these components. And frankly, these numbers are somewhat arbitrary. These are what I feel to be the right weights for these, and I'll explain that briefly right now. So the first one is cash burn. The reason that I have this in there is that if for whatever reason the market turns south and McKaylee's team has to rent it out as a rental and hold, and we have to extend your term to, let's say, 12 months, we want to make sure that they're cash flowing as a rental, right? So, and that's net of paying you interest, paying insurance, property management, and all that, okay? So that's pretty important. The next one to the right is product marketability. We probably don't want to be lending on condos or, one bedroom, one baths, or kind of unique housing shapes or designs, 6 bedrooms, 4 baths. Anything that's not going to be easy to sell to the market is a risk. And that comes in school ratings, crime ratings, square footage, and just the overall general layout of the house. And so one of the key things that we want to make sure is that we're lending on deals that the market will see as desirable. Okay, so market or product marketability is definitely one of the key attributes here. The next one around, shouldn't be surprised, leverage and risk. So this is a matter of the LTV, the variability in the comps, and a number of other factors, but ultimately the leverage and risk is one that you should care about and does make up 1/3 of our overall score. And then the last one, and maybe even arguably the most important, is how much profit incentive do they have to do the project, right? And if they only have, $4,000 of profit in the deal, and there's one mistake in the rehab, which there always is, does that make it go belly up? What incentive would they then have to do the project, right? Now, obviously, we have a working relationship, so even if that were to take place, we'd probably figure out a way to get through that. But my point is, the more profit, the more incentive they had to do the deal and ultimately execute in a timely fashion, okay? So all of these things come together to give an index risk score of a 0 to 1. And really anything above a 0.51 is deemed worthy to do. Anything below that is more cautionary, okay?